Does Medicare cover walk-in tubs? And unfortunately, Medicare does not cover walk-in tubs, but there is an alternative way to pay for your walk-in tub, and it's pretty interesting if I do say myself. So if you didn't know, walk-in tubs can be ridiculously expensive if you're paying out of pocket, and so according to the National Council on Aging, just the tubs are going to cost anywhere between $2,000 to $20,000, depending on the type of tub you get and the features that come with it. And then installation is going to cost anywhere between $1,000 to $20,000. Again, depending on the type of tub that you get, the features, the plumbing that's going to have to be installed, potential remodel to get the tub to fit where it needs to go in the bathroom. I mean, there's just a lot of variables here. So you're looking at anywhere from $3,000 to $40,000 to get a walk-in tub. So the question then is, how are you going to pay for it? How are you going to pay for that walk-in tub? So we know Medicare is not going to cover it except for rare circumstances. Medicare Advantage, again, it's unlikely to cover unless medically necessary and certain rare circumstances are met. And they may pay for a small portion of it, but they're not going to cover it all. So where most people end up at is either using the retirement savings or getting a credit card. The issue with retirement savings is that may or may not be a good idea, depending on how much money you have, what the impact to your retirement plan would be, and then also how, if you pull money out of a retirement account and then one of you passes away, how does that impact the remaining spouse? Are they going to have enough money to be able to live comfortably through the rest of their retirement? And then credit cards, obviously that's where a lot of people go. And the reason is because it's relatively easy to get a credit card. The problem is now you're taking on a new monthly debt payment that can be unsustainable, especially if you lose a spouse, or you just never get it paid off just because of the minimum payments required and not paying more. I mean, it could take a long time to get a credit card paid off. So what I did is I went to bankrate.com to their credit card calculator, and I went on the low end for the cost of a purchase and installation of a walk-in tub at $15,000. And assuming a 24% interest rate, your minimum payment would be $450 a month, and it would take you over 30 years to get paid off if you just made the minimum payment. So again, not a really good choice to pay for the walk-in tub. But as I mentioned earlier, there is an alternative way to pay for the tub, and that is to use a reverse mortgage. And there's a lot of reasons to use a reverse mortgage beyond just having access to cash to pay for the walk-in tub. First and foremost is it gives you access to income tax-free cash, which then if you use those proceeds from the reverse mortgage, it could help you retain your retirement savings. Another option would be the ability to consolidate debt to free up cash flow. So not only could you get the money to pay for the walk-in tub, but you potentially could also consolidate credit cards, car payments, a mortgage, other debt that you have to, again, free up cash flow for the household, which would be great. And then you also, which I think is probably one of the most important things, is to be better prepared for other large expenses during retirement, whether that's healthcare costs, long-term care needs, so assisted living or in-home care, home remodels or repairs, maintenance, car repairs and maintenance. I mean, there's a lot of other expenses that can pop up that could wipe out a retirement savings fairly quickly. So let's take a look at the scenario of George and Linda. They're both 75 years old. They have $3,600 a month of income, so they each get $1,800 a month from Social Security. They do own their home free and clear. It's worth about $400,000, and they have $65,000 in retirement savings. The issue is George's health and strength is failing, and so for health and safety reasons, they need to get a walk-in tub. But they don't want to use retirement savings because Linda's going to need it when George passes, because again, they're going to lose half their household income. And so Linda needs a way to supplement her income after George passes away. And they definitely don't want to use a credit card and leave Linda with payments either that she can't afford or would be a financial strain once George passes and that household income is lost. So they reached out to me to see if a reverse mortgage might work for them. And so we have two different options here. The first one is to get the reverse mortgage and make no monthly mortgage payments. They still have to pay their taxes and then their insurance, property insurance. And their reverse mortgage is represented by this bar chart here. The blue represents the home value, assuming a 4% appreciation rate. The orange represents the loan balance. And initially, we're starting off with $32,000 because we're going to pull out money to pay cash for the tub and installation, and then we're lumping in the closing costs. And we can see this loan balance is increasing over time. And that's because in this scenario, we're making the assumption that George and Linda are not making a monthly mortgage payment. They still have to pay their property taxes and insurance, but because they're not making a payment, the interest in mortgage insurance is getting added to the loan balance. The green represents a line of credit. And after drawing out the funds and lumping in closing costs, this is what they have still available to them. And we're starting off with $131,000, but we can see this line of credit is actually growing over time. And the reason the line of credit is growing is because any funds that are available in the line of credit grow at the current interest rate plus 0.5%. And so there's just more and more money at some point in the future for George and Linda to draw from. The second option is to get the reverse mortgage and make a monthly payment. And they figured, you know what? If we were to finance this on a credit card, we'd have to make payments anyways. So why not get the reverse mortgage and make a payment towards that? And so, again, the blue is the same. The home value has not changed. The orange, we can see that about year 7 or 8, they've almost got this thing paid off, so they just stopped making payments. And so by year 10, they owe $863. Again, they're still not making payments. And in 15 years, that turns into $1,240. They still have to pay their property taxes and their homeowner's insurance. But what has changed significantly is their line of credit. Their line of credit is now much larger than it was had they made no payment at all. So if we look at year 10, previously by making no payments, they had $272,000. And by making payments, they have $338,000 in their line of credit. So they've added well over $50,000 to that line of credit. And the reason that has happened is because any money that they pay towards the loan balance not only reduces the loan balance, but it increases the line of credit dollar for dollar. And remember, any funds in that line of credit are growing at the current interest rate plus 0.5%. So it's almost like by making a payment, they're putting that money into a savings account that they have access to at some point in the future. Now, the other great thing about this is if they pull any money out of this line of credit at any point, George and Linda still do not have to make a monthly mortgage payment. They still have to pay their property taxes and their homeowner's insurance, but any funds that they draw, they do not have to make a payment. Now, let's assume that in 5 years, George passes away, and now we just lost half the household income. At that point, Linda, should she choose to do so, could start drawing money out of this line of credit to supplement her income. And let's say Linda didn't need to, and so by year 10, this has grown to $338,000. And now, at the age of 85, Linda needs help. She needs some in-home care. Somebody to help her with her daily chores, helping getting in and out of bed, taking a shower, whatever it may be. Now Linda has a significant amount of money to be able to pay for that care. So again, this isn't just about getting money to pay for a walk-in tub. It's also about setting yourself up to be more financially stable at some point in the future, and that's what the reverse mortgage can do. So through the examples that you just saw, I think you would agree with me that there's some pretty good reasons to consider getting the reverse mortgage to pay for a walk-in tub, especially since Medicare and Medicare Advantage programs are unlikely to pay for it. First and foremost, you're not getting into credit card debt. And credit card debt is brutal if you're living on a fixed income. It's really hard to get it paid off and get out from underneath that debt. Secondly, you have the ability to retain your retirement savings. So instead of pulling a big chunk out to pay for your walk-in tub, you could use the reverse mortgage proceeds to pay for that. And by retaining the retirement savings, then you have funds to deal with future expenses when they pop up. And then we're creating a lot of flexibility in that monthly mortgage payment because, again, the reverse mortgage, you have the ability to make a payment, but you also don't have to make a payment if you don't want to. You could pay as much or as little as you want whenever you want. You can stop, skip, reduce, start again. It just gives you flexibility that any other financing option does not give you. And that's really important if you're a couple, and especially if one of the spouses passes away and household income is lost. Will that remaining spouse be able to continue to make the payment on any other type of financing vehicle? So the other thing is that it creates an additional source of retirement funds with that reverse mortgage line of credit. So beyond just being able to pay for the walk-in tub, you now have a line of credit that could be used to supplement your income, especially if a spouse is lost, and it's creating another source of funds to deal with other financial shocks that are likely to pop up. So again, large medical expenses, long-term care needs, home maintenance, all of those things can be financially devastating, and now you've got another source of funds to be able to deal with those. And then here's the really cool thing is that you have access to all of the funds paid towards the reverse mortgage at any point in the future. So it's kind of, when you make a payment towards the reverse mortgage, it's almost like putting that money into a savings account. There's lots of benefits to do that. And so any payment you have or make, you could pull that money right back out if it's needed. And you just got to follow your loan obligations, which are primarily living in the home as your primary residence, paying your property taxes, your homeowner's insurance, and any other fees associated with owning your home, and taking care of the property. You're doing those things, you'll always have access to those funds that you've paid towards the reverse mortgage in that line of credit. Want to see if this would work for you? Want to take a look at what your numbers would look like? You want to do some forecasting to see what it would look like if you made no payment or made payments? Give me a call. There's no cost to speak with me. There's no cost for me to put any of those numbers together for you. And I'm happy to answer any questions that you have about reverse mortgages. And I really look forward to speaking with you. Thanks.